So I'm going to take the next 15 or 20 minutes talking about what we see in terms of trends in the global housing market and also our perspective on that. Uh, a quick introduction before I start. So I'm Ketan Thaker. I head up the European RMBS and covered bond teams at DBRS. So let's see what's happening with house prices. The chart that you see here actually shows an average of real house prices across 57 countries. And thank you. So it shows an average of a pretty global picture in terms of what's happening to house prices across the globe. And it seems we have reached quite an interesting milestone recently. If you look on an average, house prices are now at the same level at just before what we had at the global financial crisis. So what has been driving this growth in house prices? And more importantly, what does it mean? So let's look at the drivers for the growth price for the growth in house prices. Now, housing is actually very, very local, and there can be factors at a local level which drive local house prices. But nevertheless, there are certain factors which are pretty common across many markets that you look at. First of all, I think one of the reasons house prices have grown so rapidly is that since the economic crisis, the world economy has done well. So you see uh, more people in employment, higher prosperity, and that generates a demand for housing. One of the big contributors, especially here in Europe, closer to home, has been low interest rates. Low interest rates makes mortgages a lot more affordable for everyone. It also, in many places, you will find, and this is pretty much universally true across Europe, your mortgage is probably lower than the interest in the mortgage is lower than the rent you pay. So it's more affordable and it's probably more attractive than renting. So I think that has helped to a great extent. The other thing is the mortgage credit availability. We saw the discussions in the previous panel about low interest rates. And given how low the interest rates are, mortgages still represent a pretty attractive assets for banks. And in most countries, you see a fairly healthy competition between banks for on the mortgage side. So borrowers are finding it easy to borrow. And finally, the other factor has been the demand side. We have seen a pretty strong population growth, both in terms of just the organic growth in the population, but in many countries and big cities, we have seen an influx of people in the form of either immigration or just internal migration from rural areas to more urban areas. All that combined has been quite supportive environment for the house prices. So that's the story so far. But what does it mean for the future? Are we just seeing the same movie again? And should we start worrying about the same thing that happened pre-crisis? I think there are also some important differences between what happened pre-crisis and the house price growth that we have seen now. I think the one big factor is the difference in credit expansion. I just mentioned mortgage credit availability remains good, but if you just compare the growth in mortgage volumes, they are pretty modest. They're probably no more than, I think, half the rate at which mortgage credit was going pre-crisis. So we are not seeing an expansion in mortgage credit, what we saw pre-crisis. Because a lot of the growth in pre-2007-8 was about a pretty rapid expansion in mortgage credit and also credit to borrowers who probably couldn't really afford or manage their finances. So I think that is one big difference this time. Secondly, if you look below the surface in terms of growth, unlike the growth of the 2000s, which was pretty widespread and uniform, there are quite big differences in house price movements across different countries, but even within countries between urban areas and rural areas. So you would expect in a typical bubble phase, everything moves up, but it is actually not happening, at least as of now. Also, most of the lenders and the regulators still remember what happened in 2007. The memory is still fresh. So people are cautious. We still don't see the criteria creep and the kind of poor quality lending, some of which happened pre-crisis. So I think there are a number of differences between what happened last time to this time. But let's look slightly beneath in slightly more detail as to what's happening in the more recent 2 or 3 years on house prices. So while house prices have been growing, The other factor important is that we think the growth is running out of steam slightly. So we just looked at the G20 countries and looked at the real house price growth in 2016, 17, 18. The interesting thing we find is if you look at, except for Germany and Mexico, if you look at all the other 18 countries, either you have negative real house price growth or the house price growth, which is slower than what you had in the past. So well, house prices are growing, but we think going forward, you'll probably see a slowdown in the growth in house prices. And why is that? I think the single biggest factor is affordability. I mean, put simply, many places houses are so expensive that people who live and work in them cannot actually afford to buy them. UBS towards the end of the year did an interesting report where rather than look at the average salary of the population, they looked at in cities the average salary of highly skilled workers, and they compared what would it cost those workers to buy a 60 square meter house, fairly small property. And if you look at some extreme examples, I mean, Hong Kong is an interesting one. In 2008, for a skilled worker with an average salary, it would have cost them 12 times, the house price was 12 times their income. In 2018, it was 22 times their income. So it's almost you either need a inheritance or a lottery win to actually afford to buy houses in the city center. To a similar extent, closer to home, if you look at London, the story is similar. It went from 11 times to 15 times. And even closer here, if you look at Munich itself, Munich in 2008 was 4 times the salary, it's 8 times now. So you are seeing reaching a phase where there is demand for housing, but the houses are just becoming too expensive for people to afford them. The other thing this has led to is that because buyers are being crowded out, locals are being crowded out, there has been political and regulatory intervention. You see that across the globe in the sense, if you see London, there is the stamp duty has changed. There are extra taxes on foreign buyers. You look at cities like Hong Kong and Vancouver, there's taxes on empty properties, there's taxes on foreign buyers. And I think we are going to see more and more of those kind of regulatory and policy interventions because ultimately people who locals are also voters and politicians don't want the locals to be priced out of the market completely. The other thing which I think probably not so much in Europe, but if you look at, for example, Australia, interest rates have started to rise. And in fact, Australia was a pretty strong market. And last year, Sydney, after a long time, saw a real house price decline. And that was pretty much to do with rise in interest rates. So in some markets, I think interest rate rises will probably test the confidence of the market. I think the other thing in terms of outlook, probably to also keep in mind, is we face some significant event risk in the form of Brexit, for example, here in Europe, but also the global economy might also slow down because of other things like the US-China trade wars. And ultimately, if the economy is slowing down, it will impact what happens to house prices. So if you now just look at which are, I won't spend a lot of time on this, but if you look at what are the countries which have really outperformed, I mean, you see some common trends. I mean, for example, from 2010 to 2018, India, Canada, for example, performed exceptionally well in terms of real house prices. And in both cases, you see a growth in population. In the case of India, there is, of course, a lot of housing demand because the population is growing, but the prosperity is increasing. More and more people want to buy their houses. There's a lot of push from the government. Has a very ambitious target to get people into their homes. If you look in places like Canada, it's a similar thing. We are seeing growing population, a drop in interest rate, a lot of foreign investors in certain markets, and the view, or even locals see it as a very safe asset, and we have seen a lot of investing in the property market. A story for Germany again is dissimilar. The economy has grown, and we just look at the combination of inward migration in Germany plus the unemployment rate going down. You roughly have 10% more people in employment today than what you had 10 years ago, which creates is demand for housing. As usual, supply is not meeting the kind of demand you have. For example, in Munich here, the vacancy rate is close to zero on property. So there's quite a high demand for property. I mean, if you look at, on the other hand, underperformers, I think we are seeing a sort of similar story. The worst performing markets probably have been Russia and Italy since between 2010 to 2018. And in case of Russia, you have seen a combination of some population decline, but the economy has also not done very well. It's quite closely correlated to what happens to oil prices. And if you since the drop in oil prices and the sanctions that were imposed by the US, you can see Russia has probably done pretty badly. Italy has other issues. The government has a debt problem. You have a slight demand issue, and especially certain markets in the south of the country. So, coming back to the point I was making earlier, you see house price on average growing, but the story is not the same everywhere. There are differences, and there are good reasons why house prices are increasing in certain markets, and good reasons why house prices are not increasing in some markets. So, if we just look at the future, what we think would be the drivers of house prices going forward? Now, a lot of it is quite obvious. It's just a repetition of what I said in terms of what has supported house prices. So, longer term economic growth remains the key because ultimately income, house prices, rents should move in tandem. And if you have a big disconnect between them over a long period of time, things are not going to work out. So, economic growth remains the key. The other, we have just shown, I've shown an example of UK as an example, but interest rate long term are also kind of quite closely correlated with house prices. The relationship breaks down slightly during the crisis period when both rates fell and house prices fell. But if you take a long term view, interest rates are generally quite a good indicator of also movements in house prices. The next is the population growth. I mean, growing population is going to lead to more demand for housing. So again, that's quite important. Now, these are sort of generic factors, but I think the other important difference we are seeing in terms of the house prices is the impact on large cities is quite different to the country overall. And there are a number of things we are seeing on some of the large urban centers where you have demand not only from the growing population, but we have some new phenomenon like Airbnb was a new thing 10, 15 years ago. Now, there are cities where it has reached such an issue that the regulators are trying to clamp down and put extra restrictions on short-term letting. It's not only pricing out the buyers, but also people who want to rent for longer term. So you see a continuing impact of those kind of trends. Uh, Cities have, by definition, are quite densely populated and have limited amount of space. And in addition to space, there are local issues why bringing on supply of property is not very quick. It takes the planning rules might be quite strict in many countries. So, in generally, we see a supply shortfall continuing, and this is probably going to be a focus for governments and regulators to make sure how do you create enough housing for the population which is needed. More longer term, I think there are other things which will also impact in terms of the social change. So we are seeing an increasing trend where if you have good transport connectivity, good broadband, people don't really need to live in the city center. And with flexible working and people having the ability to not be have to be as close to the office as they used to, might actually be part of the solution on how do you kind of reduce the demand on house prices in the city. I mean, these are by no means the only factors. There are many other things like the availability of credit, the taxation, the regulations, which has usually quite a lot of impact on house prices. But we think these are some of the kind of very key drivers which will determine what happens to house prices going forward. So, in terms of all this, what does it mean, and what is our outlook? I guess in terms of implications on the interest rate side, I think the interest rate rises would have to be a lot more gradual. Policymakers realize that any sharp rises in interest rate will probably test the housing market. Uh, Bizarrely, because of Brexit and the US China trade issues, in fact, the probability of rate rise has now reduced rather than increased. So I think we are looking to at a scenario where rate rises are probably now even more delayed than what they would be. But we think the rate rises would be relatively uh, gradual. There are certain things quite difficult to predict as to what would happen in terms of big event risk. So things like Brexit might not only affect house prices, but it might also affect the migration patterns of how people move between countries, and that can eventually have an impact on the housing markets. I mean, migration is going to be long term, going to be quite a key. I think it was already mentioned about by 2050, most people will be living in cities. I think the UN predicts right from about 50% of people living in urban centers to about 68% or 70% by 2050. So we are going to see a huge move of people from rural to urban areas over time, because that's ultimately where the jobs and the economic prosperity is, and that is going to affect a lot of the policy and the government actions that we would see. Uh, I already touched on the supply constraint. I think what it's going to mean is many cities and countries would have to relook at how they approach planning. We'll probably see much more vertical cities, because if you don't have land, the only way you can then create housing is to kind of go up. It's not very popular in many places, but over longer term, I think those are the kind of things people will have to relook. Uh, the other kind of thing which we already are seeing is macroprudential measures. I think in Europe we see measures in the form of LTV limits, in the form of debt to income limits, in the form of higher capital charges on higher LTV loans, because regulators are concerned about another bubble. Often these measures can be a bit slow and probably reactive rather than proactive. But I think we see it in Ireland, we see it in Netherlands, in Sweden, Norway, Finland, Estonia. So we are probably going to start seeing more and more of this regulators trying to uh, prevent another bubble. So we'll probably see more uh, macroprudential measures. Uh, Now, what does it mean for the day job that I do? So for us, housing is pretty key, because whether it's covered bond or RMBS, we look at how much losses you could suffer because of defaults on mortgages, and the loss given default is pretty heavily influenced by our views on house prices. So this is something we look at very closely. Uh, the way we do it, we have a formal annual review of all methodologies, but even more than that, for example, UK is a good example where Brexit is going to happen. We look at things a lot more closely and a lot more periodically. Uh, in addition to just looking at the price level, we also look at just the general health of the housing market, in the form of how long does it take you to sell properties? If you sell a property, how does it compare to a repossessed property compared to a property which is sold in the open market? So it's something we kind of look very closely. We try and look at the past to see what had happened and try and see if we can learn something for the future. So we benchmark the previous stresses to what we are seeing now, and eventually all that translates into our market value decline stresses. So for typically what it means is, for markets which have seen very high growth and have very more volatile house prices, the kind of stresses we apply would be higher than for markets, for example, which have seen much weaker house price growth. And this stresses eventually kind of translates into both the assumptions we make on rating for RMBS as well as covered bonds. In addition to just the stresses we do, we also trying from our side to increase the transparency. So this is so for example, very recently we have launched a tool called Viewpoint. This allows you to this is a free tool, and it allows you to look at all the pools which are in the European data warehouse. Unfortunately, covered bonds are not in there, but if you look at all RMBS pools, even if they're not rated by DBRS, you can actually use the tool to see on various portfolios, if as an investor, if you have exposure to, where are your mortgages lying? So what kind of regional concentrations you have, what kind of LTV profiles you have. And this, in a way, gives you a quite a nice way to visually see various things. Currently, we only cover UK, Netherlands, and Spain, but that's something we would want to cover more markets as we go forward. So I'd like to just conclude with a quick summary. So I think you think house prices are now to come back to the peak of 2007, but the rises are not uniform across all countries and all cities. Generally, it's the big cities where people are moving into and where there is a lot of demand constraints, which have seen the most rise in house prices. I'm a ratings analyst, so I'm designed to be pessimistic. So I mean, we don't think this is going to actually continue. The house price rise we have seen are going to continue forever. We think there are markets is going to slow down, and we'll probably see either small declines or a much slower growth in markets going forward. But still, we don't think it's actually time to panic. It's more time to be vigilant rather. And the key things for us would be the big economic events which could disrupt economic growth and the long-term trends on the population growth. So I think with that, I've come to the end of my 20 minutes. So I'd like to just thank you everyone for your giving me your time. Hopefully you found that interesting.